Okay, good morning and welcome back, everyone, to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And we are starting off this week sort of once again with a bit of a negative tone here to start off the week. As of last Friday, we tried to make a new all-time high at the end of last week. And so far, what we've seen here from markets were effectively a rejection at those all-time highs, as the S&P 500 attempted to get breakout above that 6130 level. Could not manage to close back above that level, and we managed to trade right back into the trading range. And yesterday's price action further brought brought the S&P 500 below the 50-day moving average. So and we've seen that across on both the S&P 500 and the NASDAQ 100. The Russell 2000 obviously recently getting rejected, the 50-day moving average as well, which has actually been acting as resistance the entire time for the past nearly 3 weeks or so. The Russell 2000 trading significant below and actually starting to test, the next major support level here, which is around 215 on the IWM. And then you see the equal weight S&P 500, the only one that actually held on to the 50-day moving average yesterday. So this is one to keep an eye out on with regards to whether or not this sort of risk or risk-off environment continues to spill into the markets here this week. We certainly have had earnings so far this week that haven't been particularly strong. We do have NVIDIA earnings at the end of tomorrow that I think is going to be a highly anticipated earnings announcement. And then you have the core PCE, which is the Fed's preferred inflation data coming out on Friday morning. So we have a busy week with regards to economic and corporate data this week. But so far, starting off this week on a more bearish tone here as the markets failed to continue higher after printing new all-time highs last week. You see that growth that has underperformed value has continued to underperform here. We've seen value continue to outperform growth here on this recent pullback. You have commodities continuing to moderate a little bit here after gold. As gold continues to grind higher, we've seen oil pull back here to that $70 support level. But at the moment, you still have HYG at the corporate bond ETF continuing to grind higher here, not pulling back here, and not being concerned from a credit risk perspective as it makes new 52-week highs. That is the one highlight here of the equity markets, is that the bond markets so far are catching a bit of a bid and continuing to ease some of the conditions. The interest rates that we've seen that have been stubbornly high here over the past few months show some form of relief here, which is going to provide a little bit of a tailwind for equities. But as you can see, the VIX continues to remain fairly elevated here, just around the 19% level. Traders expecting a fair amount of future volatility over the next 30 days. So certainly a lot more fear here in the markets, especially since we were just away just off the all-time highs from just a couple of sessions ago. As you can see, the 10-year yield currently trading just around 4.3%. We've seen bonds catch a bit of a bid here, forming a bit of a base here above the 50-day moving average. This certainly forms the potential basis for some further upside here for bonds. We certainly have the bond markets digesting news out of Washington with regards to the Doge and how much of the federal budget they can slash here. So far, the markets have not particularly been optimistic and moving ahead of the curve. But I would say that the bond markets are watching just how much Elon Musk and Doge are capable of saving from a tax dollars perspective for balancing the US budget, that is going to be one of the major drivers of sentiment here for bonds and bond prices. If even if he can slash expenses for the US, that is even a fraction of what he originally claimed on the campaign trail, which is between $1 to $2 billion, even if we just a few hundred thousand, I'm sorry, a few $100 billion, that would be a significant change in terms of debt for the U.S. For U.S. Treasuries, and will likely have a somewhat meaningful impact on Treasuries and see those yields decline and provide a more supportive environment here for equities. If the dollar index broke below 107, a major support level here, our expectation is to see some further downside here for the dollar index down into the 105.50 area. Bitcoin breaking below 90,000, that would sort of complete a bit of a topping formation here. So we'll have to keep an eye out here, depending on how you draw your lines. Certainly 90,000 is a pretty significant psychological level here that, we've kind of completed a bit of a topping formation. And that's one that I think is important to keep an eye out for a potential breakdown. The last level here is 87.50, which so far we're still holding on that at the moment. Gold continues to rally here, towards the 3,100 level. Oil has kind of found a bit of a bounce here off that $70 level here at the moment. And then if you look at the sector rotation, technology continues to be on the weaker side. We started to look like what was a bit of strength here for technology. We've given some of that back here in just the last couple of sessions. So overall, what we continue to see is a more of a deterioration or an outflow for sectors like consumer, discretionary, and technology. So two of the leading sectors, um, we're now seeing starting to lag behind a little bit. Now, that in itself, not a bad thing, because sectors that are leading need to rotate. They need to see leadership in some of the lagging categories, and some of the lagging categories need to start show some leadership. So we're seeing a little bit of that right now. Certainly, some of the more defensive sectors have come back to life. So that's certainly something to keep an eye out for. Communications continues to be one of the sectors that outperforms. Financials continues to outperform as a sector. But as you can see, consumer staples recently coming back to life here a little bit. As you can see, consumer staples revisiting all-time highs here as it outperformed the S&P 500. You also have a little bit of flight to safety here in healthcare. Um, and both materials and industrials have started to turn back lower after what seems like a little bit of outperformance. Real estate starting to see a little bit of outperformance here from real estate as interest rates continue to decline, and utilities also catching a little bit of a bid here. So definitely more of a defensive tone here, with the exception of home builders. Home builders, big underperformance and actually continuing to underperform in this current market environment right now, despite interest rates, ticking down a little bit here. And semis continues to underperform here. Going into NVIDIA's earnings on tomorrow, the relative strength here of the semiconductor industry and just overall NVIDIA as a whole is not particularly strong here. Definitely one of the things that's more concerning for NVIDIA's earnings tomorrow. So, that's kind of where we stand here from a macro perspective. I think what we'll do is we'll turn over to some of the individual ideas that we want to take a look at here during today's session. So the first one that I want to point us to um, are some of the airlines. Specifically, if you look at Delta, um, Recently, Delta broke down below $64. After gapping higher here, it formed this bit of a top and started to break down here below, break down below 64. That's definitely one level to pay attention to here right now. As you can see on a relative basis, we're testing a major support level here as well, even though we've broken it from an absolute basis here. If this were to break on a relative basis to the downside, this is really where we could see some substantial further downside here from some of the airlines. And Delta, trades about 8 times forward earnings, which is roughly in line with historical averages. However, if you look at growth expectations right now for Delta, we've started to see that moderate a little bit. We've also seen net margins compress a little bit over the last couple of quarters. Um, the overall outlook for some of the airlines are starting to be a little less rosy. We've seen a pretty substantial rally here from Delta that was a $38 stock that nearly doubled to 70 in the span of 6 months, um, showing a little bit of weakness here, which is not particularly a bad thing given how much the stock has run in such a short period of time. The other one I want to take a look at here is Amazon. Amazon recently also breaking down below some major support levels here around 225. You can also draw your lines this way here as well. So however way you draw it, we've now broken below some major support levels here. And notice how as we break below those support levels, it has significantly underperformed the S&P 500 in just the last few weeks. It's underperformed the S&P 500 by over 10%. The Magnificent Seven have continued to underperform and show signs of weakness. And this is something that I think is important to be aware of, especially since Amazon trades at a very rich valuation of about around 35 times forward earnings. Growth expectations and net margins on Amazon are not, in my opinion, supportive of a valuation that's that high. There's a couple of names that fit into this particular category. Probably the most important one right now for investors is Apple. Apple trades at 33 times forward earnings, and as you can see, you've kind of got this double top here around 245, 250 level. That's one that I think is worth paying attention to because that's really where I think you could start to see this stock roll over. Trading at 33 times forward earnings, you expect a growth that's well into the double digits, which is not true here for Apple. We're expecting EPS growth of around 11% and revenue growth of about 6%. That's largely in line with what the S&P 500 is expecting, yet it trades at a valuation that's nearly, 60% higher than the average S&P 500 stock. Net margins are strong for Apple at 24% versus the industry average of around 12. But that is really the only thing that supports a more premium valuation. And I simply do not think 24% net margins can justify 33 times forward earnings. You look at Meta, you look at Alphabet, you look at even Microsoft, but probably most importantly, Nvidia. These are stocks that are trading at substantially lower valuations compared to Apple. Yet, if you look at their growth expectations, they are leaps and bounds higher than Apple. So, for those reasons, I think Amazon and Apple are both at risk of some further pullbacks here, especially given the valuation that they continue to trade at right now. Now, I did talk about Baba here last week briefly, and we got the breakout here above that 120 level here. We're getting a little bit of a pullback here. That is the potential opportunity to seek some further upside here. Alibaba, obviously, outperforming here in the US markets due to the news out of China that Jack Ma is effectively back, that he's got full backing and support of the US government. And this is very much a an experiment to jumpstart the Chinese economy with the help of their major tech companies. We have seen over the last few years a regulation crackdown that effectively wiped out a few different industries, which tech was certainly one of the industries that took it on the chin as a result of the different variations of regulations that China have put in place. And we all know about Jack Ma, effectively disappearing out of the public eyesight for the last 3 years or so. Made his first appearance last week, showing some level of confidence in the Chinese tech sector and just overall willingness for the Chinese government to invest in the Chinese tech sector as they clearly are trying to replicate the success the US has had from their tech companies driving kind of global growth. China has at this point very similar ambitions. Competition is good for the consumer, not necessarily good for the companies that are competing. But one of the things that we can expect out of all of this is, increased spending, especially in some of the key industries, such as the rollout of AI. Um, as these different countries are competing for dominance in this particular space, it's going to require more and more computation in order to actually take what they've built and make it a viable product. And that's really something that I think is going to be the biggest pain point and the biggest driver of who's successful and who's not in this like next phase of kind of the AI journey that we're all sort of on at the moment. The other one I want to take a look at here is PDD. The owners of Temu. This is one that I do think it's very important for investors to understand that at the moment, given the uncertainties around tariffs and trade wars, this is the type of stock that is very much at the crosshairs of that particular risk. Now, the only reason that I think it's worth taking on the risk is really because of the valuation that it trades at. PBD trades at around 9 times forward earnings, which is around versus the industry median around 22. So it trades at a very heavy discount relative to its peers, despite the fact that it's growing either in line or faster than its peers and is more profitable than its peers. So the fact that it trades at a lower valuation, speaks to the upside potential here for PBD. But it is important to understand the downside risks with these types of investments here right now. Newmont Mining, we talked about this here last week. It's pulled back here a little bit to that $44 support level. This is really an interesting opportunity to continue to take some exposure to the upside with gold through a mining stock. And also always provides a bit of a leverage play here on gold itself. You have Amgen. We talked about the fact that healthcare has been we've seen inflows into healthcare as a more defensive sector, and Amgen, one of the beneficiaries of that. Amgen, as you can see recently on earnings, broke out higher here above this double top and into continuing on, and our upside target here is around 315. So we're just about to close at our 315 target here on Amgen. Lam Research. This has been a bit of a volatile play here, but really what we're looking for is the completion of this bottoming formation and that breakout. And that's exactly what we've gotten. Each time we've broken out, there's been pretty significant pullbacks here, but we keep making higher highs and higher lows. And that's what's important here, is looking for that continuation higher here for Lam Research. Two stocks that I think are still worth paying attention to here right now is CME. CME recently breaking out above that double top and continuing to move higher here with net margins of 57%. It's a really interesting play that's trading around 22, 23 times forward earnings at 57% net margins. This is a company that's hugely profitable for every dollar it gains in terms of revenue. Um, and this is simply just another opportunity for shareholders to unlock some value here in a stock that is incredibly powerful from a profitability perspective. And I think with a very reasonable valuation is an attractive opportunity for investors as well. Same thing for Visa. Um, Visa, after that big rally here above that double top around 320, has broken all the way out to that 350 level here. It's moderating a little bit and trading sideways and consolidating. But this is really where we see some further upside here for Visa. Visa does trade around 30 times forward earnings at this point, which has started to get a little bit more expensive. But with 55% net margins, those types of premium valuations at the moment, I think are justified and can continue to trade at those valuations in the short run. I'm sorry, not Alibaba. Boeing. Boeing continues to grind higher here. We're looking for a higher highs and higher lows, and that's exactly what we continue to see here from Boeing. Um, we really would like this slope to continue upwards to the right. And looking for that to continue. Boeing still trading around 1.4 times sales, which is a one of the lowest valuations within the aerospace industry. Um, and so far, not a lot of changes to our thesis since we started bringing this up a couple of months ago. You have a CEO that's far more focused on keeping their head down, focusing on things like safety and culture and trying to get through deliveries. He's got them through a labor dispute. He's got new funding for Boeing. And, he's a much more hands-on CEO that's moved out to Seattle. So as they focus on kind of increasing deliveries here for 2025, that's really kind of the turnaround story that I'm looking to play here with Boeing um, at the moment. Dexcom. Dexcom continues to break out nicely here to the upside. We were looking for this completion of this bottoming formation here. That's exactly what we got. We've got that breakout, came back to retest it, actually retested it twice, but is now continuing to take off here. Our upside target here is around 110 here to the upside for Dexcom. So we're starting to make our way up there to the upside where where our upside target is. And then I'll leave you with one last one, which is Meta. Meta recently, as you can see, after a big move, has started to pull back here. This pullback, I think, represents a pretty significant buying opportunity for Meta, trading at around 30 times forward earnings. This is a stock that is growing top and bottom line by 20, 30%. Very few stocks growing top and bottom line at those particular levels with such strong net margins north of 35%. At the moment represents one of the better opportunities within AI simply because they are already focused on turning AI products into a profitable revenue stream, unlike a lot of other companies that are currently investing tens of billions or hundreds of billions of dollars in terms of AI infrastructure that at the moment do not have a clear plan as to how they're going to recuperate their cost for AI. Right now, a lot of them are just operating under the assumption that AI is revolutionary and will change the way we do things and it will be ubiquitous, which likely it will, but that doesn't necessarily mean that every single company will succeed. And that is something that we will continue to monitor fairly closely here over the next few weeks. But I am posting um, uh, you know, I will be hosting an education session on some of that here very soon. So with that, that covers what I wanted to share with you here today. I hope this is helpful in giving you a better understanding of What the views are from a macro perspective. We have an environment that is not particularly strong here, but the interest rate environment is starting to be a little bit more accommodative for this, for the equity environment that we're in. So keep an eye out for that. With just how bearish investors have been here over the past couple of weeks, that does provide a potential catalyst for markets to turn around, especially now that we're below the 50-day moving average. So we'll keep an eye out on that and update you on that by next week and adjust our trade ideas accordingly based on what moves this week, especially with NVIDIA. So with that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week.